Every day, you use money printed by the government. You believe that money is backed by the state's promise of stability. You believe a public agency guards the entire financial system. But that is the first dangerous lie we were taught. The U.S. Central Bank, the Federal Reserve, is not truly federal. It is a system built on a conflict of interest, designed for opacity. It was conceived in secret, a gathering of the nation's most powerful bankers. They met on a remote island in 1910 to plan a fundamental shift of power. The goal was to eliminate chaos and guarantee control over the nation's money. The irony is that the cure they designed became the source of an even deeper sickness. They built a system that needs financial instability to stay alive. This is the story of the trap door built into modern banking. The year is 1907. Panic is spreading through Wall Street and Main Street. The money supply was inflexible, tied to gold and seasonal demand. When depositors withdrew cash, the entire system would freeze instantly. Factories could not make payroll, and thousands of small banks collapsed. A powerful man named J.P. Morgan had to step in with his personal wealth. He literally locked bankers in his library until a solution was reached. The crisis was averted, but the message was terrifyingly clear. The financial fate of an entire nation rested on the goodwill of one man. This fragility demanded a permanent central authority. But the bankers did not want a government agency dictating their profits. The politicians did not want private interests controlling the nation's wealth. The solution had to be complex, blending public oversight with private control. They needed a new structure that could pump money into the system discreetly. Something that looked and sounded federal, but operated like a private cartel. The location was Jekyll Island, Georgia. In 1910, a private railroad car secretly carried the banking elite there. They used code names to conceal their presence from the press and the public. The result of their 9-day meeting was the blueprint for the Federal Reserve Act. The law was passed in 1913, granting the Federal Reserve immense power. This new system was divided into 12 regional banks. These are technically owned by the member commercial banks in their district. When commercial banks join the system, they are forced to buy stock in the Fed. They receive a fixed 6% dividend on that stock every single year. This makes the private member banks the owners of the system's capital. They were promised a voice in how the money supply would be managed. The structure was intentionally confusing and difficult to understand. The word federal gave it the necessary veneer of public trust, but the core function was a private mechanism for injecting liquidity. They created the ability to literally manufacture money out of thin air. When banks need reserves, the Fed buys U.S. government debt from them. The Fed pays for this debt by creating new digital dollars on its balance sheet. This ability to inject reserves stops bank runs and financial panic. The money is created at the top, flowing from the central banks to the commercial banks. It then trickles down to the general public through loans and credit. This ensures that banks are always protected from their own bad lending decisions. The system needs bad debt to run because debt is how new money is created. It is a perpetual motion machine fueled by the promise of future repayment. But that future repayment eventually rests on the shoulders of the public. This is where the trapdoor truly opens up beneath the economy. The Fed's original purpose was to prevent crises, but the structure makes the private banks shareholders in the system. This encourages them to take on greater and greater risks. They know that if their bets fail, the central bank will step in to save them. The profits are kept private, but the bailout costs are immediately socialized. The average person pays for this moral hazard through inflation and debt. When the Fed injects new money, its value does not spread evenly. It first flows to the commercial banks and large financial institutions. This allows them to invest the freshly printed dollars before prices rise. The ordinary worker receives this money much later through wages and loans. By then, the price of gasoline, food, and housing has already jumped higher. This mechanism acts as a hidden tax on the savings of the middle class. It punishes the prudent saver and rewards the heavily leveraged speculator.
The system needs continuous expansion or it simply collapses. It needs more debt, more credit, and more people entering the leverage game. The Fed must always choose between a painful correction and infinite expansion. They have consistently chosen to kick the debt down the road. The only way to pay the interest on old debt is to issue more new debt. The core conflict is that the owners of the system benefit from its instability. This creates the endless cycle of boom, bust, and government bailout. We think the system is designed to stabilize us. In reality, it is designed to preserve itself above all else.
So, who truly owns the Federal Reserve? The answer is complex, but the power structure is clear. The influence flows from the private member banks up to the central authority. They are the first to benefit and the last to face the consequences. The entire system is an institutionalized moral hazard. Look at the financial district after midnight. The towers are dark, but the data servers inside are still humming. Invisible numbers are shifting across the glowing screens. Credit is expanding, contracts are being renewed, and debt is being created. The system keeps running because it must run to survive. We believe our stability is guaranteed by the Federal Reserve's power. The cold truth is that we are trapped in their endless cycle of debt creation. The private deal struck on Jekyll Island a century ago still governs every transaction. It is the price we pay for the illusion of control and stability. The system is rigged not by malicious people, but by its own flawed design. This quiet, perpetual motion is the sound of the trapdoor closing.